I often mention how well the ETFs SCHD and VGT complement one another. But guys, this isn't just cool in theory because of the lack of fund overlap with these ETFs and the balancing system of having a growth and a dividend specialist. A mix of 50% VGT and 50% SCHD has outperformed the market, the S&P 500, for each of the last 10 years. Now take note, I didn't say over the last 10 years. For every single year, 8 being up and 2 being down over the last 10 years. This 50-50 mix has outperformed VOO, the market. But you've probably heard things like over 90% of actively managed funds or professional stock pickers fall short of the market's returns over any long stretch of time, like 10 or more years. And you've heard correctly. In fact, it's closer to the upper 90th percentile if you also include all the funds that have fallen out and ceased to exist during the testing period. And there's good reason that one of the greatest investors of all time, Warren Buffett, believes that over 99% of us normal people should invest the vast majority of our money into a low-cost S&P 500 fund. In this video, I'm going to explain why I do not heed Mr. Buffett's advice on this particular topic, and how I have managed to outperform the market every single year since I started investing. And I would love to say I'm a brainiac, but I'm gonna reveal the real secrets of how I've done so on autopilot without making any decisions. We'll also look at how beating the market by just a couple percentage points each year compounds into some massive wealth over time. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy videos like this, please smash that like button, subscribe, and tell a friend. And most importantly for this one, drop me a comment down below with your favorite ETF combo. Let's grow. The market. Let's start with the competition, the market. It's incredibly hard to outperform the S&P 500 consistently over a number of years. The S&P 500 consists of 500 of the largest companies in the United States. And if you take those 500 companies, they make up about 86% of the entire US stock market. When you buy a low-cost S&P 500 ETF like VOO, VOO, you own a little slice of the 500 largest companies in the United States. VOO has a razor-thin expense ratio of 0.03% or 3 basis points. And this means that you pay only $3 for every $10,000 that you have invested in VOO to have it automatically managed. And you might be thinking, well, why buy all 500 of the largest companies when I can just pick and choose the top, 20 or 30 companies out of the index and buy them individually? I'll say this is exactly what I thought when I got into investing. But it's difficult to do because business is constantly evolving. About 20 companies are dropped entirely from the S&P 500 each year. This means that the company either went bankrupt or just underperformed the new up-and-comers that joined the index. But holding VOO is kind of like a cheat code. It'll automatically update the 500 companies for you in real time. You don't need to worry about keeping your market knowledge up to date. And as an extra bonus here, you'll outperform well over 90% of the financial advisors or Wall Street sharks that are hand-picking the companies and potentially getting duds. Or worse yet, the ones that are hand-picking them for you and charging fees in addition to that. I knew there had to be a way to systematically outperform the S&P 500 with other passive solutions that prioritize quality over just grabbing all 500 based on the market cap. And I was right. VGT plus SCHD equals magic. VGT is my favorite ETF, and it's up well over 500% over the last decade. VOO is up just over 200% during that period. It seems like a great idea to just throw everything at VGT and get rich, right? That is tempting, and it could very well be right. But the last 10 years has been quite the bull run overall. What happens when the next dot-com-like crash or something similar that affects technology in that manner hits us? This happened to a degree in 2022 when the total return of VGT was negative 30% for the year. VOO was only down about 18% in 2022, but I still outperformed the market. Let us not forget about the other half of the equation, SCHD. Its total return of about -3% in 2022 outperformed the market by a wide margin. And SCHD has never lost 6% or more in a single year in its entire history. VGT and SCHD have an extremely low weighted overlap of 7%. This means that they hold unique companies compared to one another. And believe it or not, most dividend ETFs are relatively heavy in tech and have anywhere from a 15 to 30% overlap with VGT. We'll dive into the specific roles and the numbers here in a minute, but I'll give you a high-level view of how this works. In a good market, VGT crushes VOO, while SCHD slightly underperforms. In a bad market, VGT crashes harder than VOO, while SCHD stabilizes the ship. When you add them together, the mix beats the market in both scenarios. Let's quickly cover the details of SCHD and VGT before diving into the 10-year backtest versus the market, and how the performance difference will compound a portfolio to serious wealth. VGT Details. Let's jump over to my screen to see why I love VGT so much. I pulled up VGT on Seeking Alpha, which I think is the best website for researching stocks and ETFs. And as you can see here, it's the Vanguard Information Technology ETF. It has $67 billion of assets under management, so it's a very mature and well-funded ETF. Its expense ratio is 0.10% or 10 basis points, which is very low compared to its peers, other growth ETFs. And here under the fund profile, the thing that's important in this summary section is that VGT is passively managed. It seeks to track the performance of a specific index by using full replication technique. So nobody is making gut decisions on what to buy and sell with VGT. And it also holds a collection of small, medium, and large sized technology companies, which I like that variety. You can see here in the holdings breakdown that it's 100% technology. Its top 10 holdings are very heavily weighted towards Apple and Microsoft at about 43% total between those two. And the top 10 holdings make up 61% of the fund. It does have 318 companies, which gives it a little diversity within the technology sector. So clearly VGT's purpose is not to provide solid dividends as a growth ETF, but I am a dividend guy. And I gotta point out that while it has a very low 0.66% dividend yield, its 5-year growth rate is approaching 8%, which is not too shabby. It does tend to grow its dividends. Now we are talking about our growth ETF, so let's get to the point, the charting. And I have this set to total returns, and I looked at all of 2023. VGT had a total return of 54% last year, while VOO, the market, was at 27. So it was a great year for technology. If you look at the last 3 years, VGT has a slight lead at 39 to 33% over the market. Over the last 5 years, we jump up to 204% versus 110, so it's looking pretty good there. And over the last 10 years, VGT is up 491. This recently dropped below 500 with a couple rough days to start 2024. And the market has also dropped, but it's still at 209%. SCHD Details. It's time to take a look at what makes SCHD the ultimate stabilizer. I've pulled up SCHD on Seeking Alpha, the Schwab US Dividend Equity ETF, and it's been booming over the last couple years. It now has over $52 billion of assets under management, and it has a razor-thin expense ratio of 0.06% or 6 basis points. My absolute favorite thing about SCHD is its methodology for selecting the stocks within the index. As you can see here, it seeks to track the performance of the Dow Jones US Dividend 100 Index by using full replication technique. When you dive deeper into the methodology, it will only select companies that have a minimum of 10 consecutive years of paying dividends, and this immediately eliminates over 90% of US companies from the initial screener. And then it looks for float adjusted market capitalization of at least 500 million, so it has to be a big enough company. And it also has a minimum 3-month average daily trading volume of at least $2 million. So these have to be well-established companies that are decent sized, traded often, and have at least 10 consecutive years of dividend payments. And then it rack and stacks the companies that made the screener by comparing their free cash flow, their dividend yield, their return on equity, and the 5-year dividend growth rate. So not only do you have to be a relatively healthy company just to make the screener, then you get racked and stacked against the other companies on very important key performance indicators. So I just love the methodology. There is absolutely zero gut decisions in this thing. The holdings breakdown of SCHD is very balanced. You can see industrials, financials, healthcare, technology, and consumer defensive are anywhere from 17 to 12%. So pretty balanced here at the top. And then it has a nice slice of consumer cyclical and energy as well. SCHD's top 10 holdings make up 40% of the fund, and it has 100 companies, 104 total holdings. And when it rebalances, it makes sure that no company is over 4%. Right now you can see companies do creep over 4 based on performance since the last rebalance, but each quarter it gets everything back intact, and then once a year it can add new companies to the mix. Now to the dividends tab. This is where SCHD shines. It has about a 3.5% dividend yield, a 13% 5-year dividend growth rate. That means it grows its dividend by 13% annually over the last 5 years. You can compare this to inflation or your yearly raises at your job. And it's increased its dividends for each of the last 12 years. So you have received more cash for each share that you own of SCHD, regardless of its price, every year for 12 years in a row. If you're more of a visual person, this is what that looks like. From 2014, you have $1.05 a share, and now in 2023, you're up to $2.66 per share. Now for the charting on SCHD, it had a pretty rough last year. I did all of 2023 here, and it's up about 5% to the market's almost 27%. Over the last 3 years, it outperformed the market 34% to 33%. Zoom it out 5 years, and it's lagging the market 98% to 110. And over the last 10 years, SCHD is up 187 to the market's 209. Doesn't quite keep up with the market, but it does shine when the market and VGT are crashing, as we will see later. The 10-year backtest versus VOO. It's time for the moment of truth. Does this stuff really work, or do I have no idea what I'm talking about? Or is it both? I've hopped over to Portfolio Visualizer and I've put in our scenario. So we have the last 10 years, that's 2014 through 2023. We're putting 10,000 into this thing, no additional contributions. Reinvest dividends, yes. And display income, yes. We'll look at that at the end. You can see here our portfolio 1 is our SCHD VGT mix, 50-50. And our portfolio 2 is the market, VOO, 100%. I've hit analyze already, and we're gonna slide on down to some of the results here. So you can see that $10,000 turned into $43,000 with the mix, and $31,000 with the market over that time. And now portfolio growth, you can see they go up at the same time and they go down at the same time. That's just sort of how this works when you have these passively managed ETFs in general. And it just slowly separates over the years. These annual returns are interesting. This is where you realize that the SCHD and VGT, the blue dot here, outperforms the red dot every single year over the last 10 years. So not just overall, but each year, whether it was up or down. You can see in 2014, it outperformed, and you go, 2015 was a low year, it outperformed. It outperforms on the real high years like these guys, and it even outperforms on the down years like 2018 and 2022, for example. So each and every year, that magical mix of SCHD and VGT outperforms the market. Over the last 3 years, you're outperforming by about 2% per year, 11.8 to 10. Over the last 5 years, you're at 20.3% with the mix and 15.6% with the market. It's been a great 5 years. 10 years is 15.77 to 11.99. That's the same as full because we have the full 10 years. There's no year to date now, which is nice. So it outperformed by about 3.8% per year over the 10-year stretch. And we're going to take a look at just how much that adds up on the next spreadsheet. And not only do you get the total returns, you can see in this scenario, all dividends are reinvested to get the total returns up above. But if you did want to take income, you do get more income with the mix than you do with the market. And it's also getting more and more ahead with the strong dividend CAGRs, compound annual growth rate, that both SCHD and VGT have. Last year in 2023, that $10,000 you invested at the beginning of 14 produced $765 of cash compared to $447 of the market. The difference compounds. Beating the market by 3.8% doesn't seem like something to write home about. But the wealth begins to accumulate quite nicely when you string together multiple years. Let's hop over to my screen and check it out. I created a simple spreadsheet to show how the difference in compound growth rate adds up over the years. So in this scenario, we're going to start with $0 invested, and we're going to put in $1,000 a month. Now the market's grown at about 10 or 11% over the last many decades. We'll assume 10% here just for a base case. So after putting in $1,000 a month in 5 years, you end up at $77,000, not bad. And then 10 years later, you're at 204,000, and you keep coming down here. You hit over $1 million, 1.3 million after 25 years, and 759,000 after 20 years. That's pretty good. Now, let's take these numbers for reference and just put them here. And instead of growing 10%, let's just say we grow at a mere 1.99% more what the market's actually done in the last 10 years. And check out the changes here. You almost hit your $1 million in 20 years instead of 759,000. And then after 30 years, you get to almost $3.5 million instead of 2.2. It's a big difference. So this is what VOO's actually done in the last 10 years if you put in $1,000 monthly starting at absolutely zero. But now it's about to get more mind-blowing. We're gonna put these here for reference. Here's what VOO ended at. Now we're gonna go from the 11.99 that VOO did, according to the backtest we just ran, to the 15.77 of the mix. Check this out. You hit 1.7 million at 20 instead of 1 million. And you go up to 3.7 million at 25 instead of 1.8. That's just 3.78% outperformance does that much to the numbers. It's wild. 8.3 million instead of 3.5. This shows how beating the market by just a little bit each year adds up as the compound effect kicks in. The mix of VGT and SCHD extended its winning streak to 10 consecutive years. And as an equal holder of these two ETFs, I could not be happier. I hold VOO as well because of its long and successful track record, and we never know what the future may hold. And plus, I guess Warren Buffett is a pretty good investor, so following his advice makes a little bit of sense, let's be honest. You're on the right track if you're watching videos like this one, reading and learning more about this stuff. Check out one of these two videos if you want to continue down that path to financial freedom. Thanks for watching, and I will see you here each and every Thursday, and normally on Sundays. Peace.